Good day, everyone. We are the Group 2, and today we will discuss the Chapter 8 Financial Reporting and Management Reporting Systems. So, before we start on our presentation, let me just give you a brief overview of today's discussion. So, our report is focused on Chapter 8, which talks about the Financial Reporting System and Management Reporting System. We will identify first the learning objectives of this chapter. Afterwards, we will begin from discussing the concepts of General Ledger System or GLS. Next is the Financial Reporting System or FRS, and of course the Management Reporting System or MRS. Next, this chapter illustrates the central role of the General Ledger System, how financial reporting process is being presented, the significant changes to the traditional financial report process in the form of Extendable Business Reporting Language or XBRL, where it also outlines the features and its implications for accountants. Furthermore, we will discuss the concept of Management Reporting System or MRS, as well as its difference from Financial Reporting System. Finally, we will examine the factors that drive the design of such applications. For our learning objectives, after studying this chapter, you should be able to understand the operational features of the General Ledger System, Financial Reporting System, and Management Reporting System. Be able to identify the principal operational controls governing the GLS or FRS. Understand the factors that influence the design of the MRS. Understand the elements of a responsibility accounting system, and lastly, be familiar with the financial reporting issues surrounding XBRL. With that, let me begin from discussing the General Ledger System. So, what is a General Ledger System? Generally, it is the heart of an accounting system. It is used to record the transactions of a company, and it manages cash, accounting entries, and financial reports. A general ledger is the foundation of a system employed by accountants to store and organize financial data used to create the firm's financial statements. So, Figure 8-1 shows the relationship of general ledger system to other information system. It shows the relationship between General Ledger System to Financial Reporting System, Management Reporting System, Inventory Control, Billings, Sales, Payroll, Cash Receipts, Cash Disbursements, Accounts Payable, and Cost Accounting. So this figure characterizes the General Ledger System as a hub connected to the other systems of the firm through spokes of information flows. Next, we will discuss the key elements of the General Ledger System. First, we have the Journal Voucher. Journal Voucher is the source of input to the General Ledger. It is used to represent summaries of similar transactions, or a single unique transaction identifies the financial amounts and affect the General Ledger accounts. Yung mga routine transactions, closing entries and adjusting entries is dumadaan muna sa journal voucher before sila ina-account sa general ledger. Ina-approve muna ito ng mga managers natin since they offer a degree of control against unauthorized general ledger entries. An example of a journal voucher is illustrated in Figure 8-2, as you can see the picture. So this figure shows the journal voucher record layout for a general master file. So what is a general ledger master file? So these are some of the examples of general ledger system database. First, the general ledger master file. It is the principal file in the GLS database. This file is based on the organization's published chart of accounts. So each record in the general ledger master file is either a separate general ledger account, for example, sales, or the control accounts such as accounts receivable control for a corresponding subsidiary ledger in the transaction processing system. So next, figure 8-3 illustrates the structure of a typical general ledger master file. So ito yung example niya kung makikita niyo sa picture. And the financial reporting system draws upon the general ledger master to produce the firm's financial statements. So hindi lang FRS ang gumagamit ng general ledger master file, but also the management reporting system, where it is used to support internal information reporting. Another examples of general ledger system database are the general ledger history file, the journal voucher file, and the journal voucher history file. The general ledger history file, so this history file has the same format as the general ledger master file. Its primary purpose is to provide historical financial data for comparative financial reports. Next is the journal voucher file. It is the total collection of the journal vouchers processed in the current period. This file provides a record of all general ledger transactions and replaces the traditional general journal. Next example is journal voucher history file. It contains journal vouchers for past periods. This historical information supports management's stewardship responsibility to account for resource utilization. Both the current and historical journal voucher files are important links in the firm's audit trail. Another example are the Responsibility Center file and Budget Master file. Responsibility Center file, this contains the revenues, expenditures, and other resource utilization data for each responsibility center in the organization. The MRS draws upon this data for input in the preparation of responsibility reports for management. Lastly is the Budget Master file. This contains budgeted amounts for revenues, expenditures, and other resources for responsibility centers. So this data in conjunction with the responsibility center file are the basis for responsibility accounting. Next, the GLS procedures. Certain aspects of GLS update procedures are performed as either a separate operation or integrated within transaction processing systems. Moving on to the next topic, we will discuss the financial reporting system, where it covers the topic of financial reporting procedures. First, what is financial reporting? This is a process of creating financial statements that inform management, investors, and the government about an organization's financial situation. Basically, its goal is to measure, analyze, and report a company's revenue. These reports are typically used to assess corporate performance, cash flows, resource utilization, and financial health. Financial reporting helps the firm and its investors in making well-informed decisions on how to run and properly manage the company. So the law dictates management's responsibility for providing stewardship information to external parties. This reporting obligation is met via the FRS. Now, who are the recipients of financial statement information? Generally, these are the external users such as stockholders, creditors, and government agencies. Outside users of information are often interested in the overall performance of the organization. As a result, they demand information that allows them to track performance trends over time and make comparisons between organizations. Given the nature of these requirements, all businesses must prepare and present financial reporting information in a way that is widely accepted and understood by external users. Next, financial reporting procedures. Financial reporting is the final step in the overall accounting process that begins in the transaction cycles. Now, these are the financial reporting procedures. First is to capture the transaction. Within each transaction cycle, transactions are recorded in the appropriate transaction file. Second, record in special journal. Each transaction is entered into the journal. Recall that frequently occurring classes of transactions such as sales are captured in special journals. Those that occur infrequently are recorded in the general journal or directly on the journal voucher. So third is to post to subsidiary ledger. The details of each transaction are posted to the affected subsidiary account. Fourth, post to general ledger. So periodically, journal vouchers summarizing the entries made to the special journals and subsidiary ledgers are prepared and posted to the general ledger accounts. The frequency of updates to the general ledger will be determined by the degree of system integration. 5. Prepare the unadjusted trial balance. At the end of the accounting period, the ending balance of each account in the GL is placed in a worksheet and evaluated in total for debit-credit equality. So 6. Make adjusting entries. Adjusting entries are made to the worksheet to correct errors and to reflect unrecorded transactions during the period, such as the depreciations. So next, journalize and post adjusting entries. Journal vouchers for the adjusting entries are prepared and posted to the appropriate accounts in the general ledger. 8. Prepare the adjusted trial balance. From the adjusted balances, a trial balance is prepared that contains all the entries that should be reflected in the financial statements. Next, prepare the financial statements. The balance sheet, the income statement, and statement of cash flows are prepared using the adjusted trial balance. Next, journalize and post the closing entries. Journal vouchers are prepared for entries that close out the income statement accounts and transfer the income or loss to retained earnings. Finally, these entries are posted to the general ledger. And lastly, prepare the post-closing trial balance. A trial balance worksheet containing only the balance sheet account may now be prepared to indicate the balances being carried forward to the next accounting period. So these are the procedures of financial reporting. Next, Figure 8-4 presents the FRS in relation to the other information subsystems. The periodic nature of financial reporting in most organizations establishes it as a batch process. This often is the case for larger organizations with multiple streams of revenue and expense transactions that need to be reconciled before being posted to the general ledger. Many organizations, however, have moved to real-time general ledger updates and FRS that produce financial statements on short notice. And lastly, Figure 8-5 presents the financial reporting system or general ledger using database technology. So Figure 8-5 this presents a financial reporting system or general ledger system using a combination of a batch and real-time computer technology. Generally, the advantages of this are it includes an immediate update and reconciliation, and it is a timely information. So That ends with my part. Now let us lend our ears to Ms. Paguital as she discusses the XBRL Re-Engineering Financial Report. Thank you.
So now let's proceed to XBRL Re-Engineering Financial Reporting, which has the three subtopics of Extensible Markup Language or the XML, Extensible Business Reporting Language or the XBRL, and lastly, the current state of XBRL report. First, let's go to HTML reports. Most companies accomplish this by placing their financial statements and other financial reports on their respective websites as hypertext markup language or the HTML documents. These documents can be downloaded by users such as the SEC, financial analysts, and other interested parties. However, HTML reports cannot be conveniently processed through the IT automation. Performing any analysis on the data contained in the reports requires them to be manually entered into the user's information system. So in other words, HTML reports is like a code that is used for making a web page and its content. For example, content could be structured or made within a set of paragraphs, a list of bulleted points, and or using images and databases. So the solution to this problem is using the Extensible Business Reporting Language or the XBRL, which is the internet standard specifically designed for business reporting and information exchange. The objective of XBRL is to facilitate the publication, exchange, and processing of financial and business information. XBRL is a derivative of another internet standard called the XML or the Extensible Markup Language. XML or the Extensible Markup Language. It is a meta-language for describing markup languages. The term extensible means that any markup languages can be created using the XML. It includes also the creation of markup languages capable of storing data in relational form in which tags or formatting commands are mapped to data values. It also can be used to model the data structure of an organization's internal database. So in the figure 8 to 6 is an example illustrated to serve to distinguish the HTML from XML using a bookstore ordered formatted in both languages. Although essentially the same information is contained in both examples and they look dissimilar in structure, information, and important difference exists between them. Although both examples use tags, words that are bracketed by the symbols, which is here, the like open and close parenthesis, which has the do and John. The way in which these tags and attributes are used differs. In the HTML example, the tags have predefined meaning. They describes how the attributes will be presented in a document, while in the book ordered in this example can be viewed visually similar to facts and must be manually entered into the bookstore ordered entry system for processing. In the case of XML order, the tags are customized to the users, and the user's application can be read and interpret the tag data. The book stored, ordered, prepared in XML presents ordered attributes in a relational form that can be automatically imported into a bookseller's internal database. So in other words, in the HTML book order, end user's computer cannot process HTML and can only display the format, while in the XML book order, end user computer can be recognized XML and process accordingly, relieving some of the burden currently placed on the web servers. Extensible Business Reporting Language, or the XBRL. It is an XML-based language that was designed to provide the financial community with a standardized method for preparing, publishing, and automatically exchanging financial information and including financial statements of publicly held companies. XBRL has advantages, which is business offers expanded financial information to all interested parties virtually. Second, companies that use XBRL database technology can further speed the process of reporting. Lastly, consumers import XBRL documents into internal database and analysis tools to greatly facilitate their decision-making processes. So here in figure 8 to 7 presents an overview of the XBRL reporting process, the key elements of which are discussed in earlier. So the first step in the process is to select a XBRL taxonomy. These taxonomies are classification schemes that are compliant with XBRL specifications to accomplish a specific information exchange or reporting objectives such as filing with the SEC. The XBRL taxonomy specifies the data to be included in an exchange or report use. So the next step is to cross-reference each account in the reporting organization's general ledger to an appropriate XBRL taxonomy element. So in the figure 8 to 8 presents part of a hypothetical company's internal database. This snapshot shows various general ledger accounts and their values. Currently, these data are organized and labeled according to the reporting company's internal needs and conventions. To make the data useful to outsiders and comparable with other firms, they need to be organized, labeled, and reported in a manner that all XBRL users are generally accept. This also involves mapping the organization's internal data to XBRL taxonomy elements. So next, company general ledger to taxonomy mapper. The mapping process is accomplished using a simple tool such as taxonomy mapper. Pictured in this illustration, note that how the XBRL tag labeled cash as cash equivalents and cash term investment is mapped to the database account labeled in Cash in Bank, Canada. So once the mapping process is complete, each database record will contain stored data as designed by the taxonomy element, which is in this illustration example. Data mapping needs to be done only once, but the embed tags are used whenever the data are placed in XBRL format for dissemination to outsiders. This allows the business entities to provide expanded financial information frequently and instant to interested parties. Furthermore, companies that use native XBRL database technology internally as their primary information storage platform can be further speed up the process of reporting. Users of such financial data, for example, investors or analysis, can readily import XBRL documents into internal databases and analysis tools to greatly facilitate their financial decision-making process. Next. So in this illustration example is the XBRL instance document. For this new database structure, computer programs that recognize and interpret the tags associated with the data attributes can generate called as XBRL instant document or the actual financial reports. The XBRL instance document can now be published and made available to users. The document can be placed on an internet server for internal user, or it can also be placed on a private data for limited dissemination to customers or trading partners, or it can be placed on the internet for public dissemination. In its current state, the instance document is computer readable for analysis and processing. To make it more human readable, HTML layout rules can be provided in a separate style sheet that web browsers use to present the XBRL information in a visually appealing manner. Next. The current state of XBRL reporting. The XBRL will likely be the primary vehicle for delivering business reports to investors and regulators. Take note that all members of the financial reporting community should be aware of XBRL as it is an important information exchange technology. So the recent progress toward that end has been substantial both in United States and internationally. Some of these developments are U.S. banking regulators have required quarterly call reports to be filed in XBRL. Second, the SEC began a voluntary financial reporting program that allows the registrants to supplement their required filings with exhibit using XBRL. And lastly, SEC announced its new electronic reporting system to receive XBRL filings. The new system is called the IDEA or the Interactive Data Electronic Application.
Hello, good afternoon. Today we are going to talk about the controlling the FRS. Sarbanes-only legislation requires that management design and implementation controls over the financial reporting process. This includes the transaction processing systems that feed data into the FRS. In previous chapters, we have studied control techniques necessary for the various transaction system, and now we will be talking about the controlling the FRS. So the potential risk to the FRS includes number one, a defective audit trail, unauthorized access to the general ledger, GL accounts that are out of balance with subsidiary accounts, incorrect general ledger accounts balances because of unauthorized or incorrect journal vouchers. In SAS 78, COSO control issues, this discussion of FRS physical controls will follow the SAS 78 COSO framework, which by now is familiar to you. Let's start with transaction authorization. The journal voucher is the document that authorizes an entry to the ledger. Journal vouchers have numerous sources such as the cash receipts processing, sales order processing, and financial reporting group. It is vital to the integrity of the accounting records that the journal voucher be properly authorized by a responsible manager at the source department. Next, we have segregation of duties. So in segregation of duties, we have seen how the general ledger provides verification control for the accounting process, and to do so, the task updating the general ledger must be separate from all accounting and asset custody responsibility within the organization. Therefore, individuals with access to authority to general ledger accounts should not, number one, have record-keeping responsibility for special journals or subsidiary ledgers. Number two, should not prepare journal vouchers. And number three, should not have custody of physical asset. Now, let's proceed to access controls. Unauthorized access to the general ledger accounts can result in errors, fraud, and misinterpretation in financial statement. SOX legislation explicitly addresses this area of risk by requiring organizations to implement controls that limit database access to authorized individual only. So they're limited only those who are authorized. A number of IT general controls designed to serve this purpose are presented in the chapter 16 when we go on in our discussion. Let's proceed to accounting records. The audit trail is a record of the path that a transaction takes through the input, processing, and output phases of transaction processing. This involves a network of documents, journals, and ledgers designed to ensure that the transaction can be accurately through the system from initiation to final disposition. We should remember that any audit trail facilitates error prevention and correction when the data files are conveniently and logically organized. Also, there are ledger and other files that constitute the audit trail should not be detailed and rich enough. Number one, to provide the ability to answer inquiries, like for example, from customers or vendors. And number two, be able to reconstruct files if they are completely or partially destroyed. And number three, to provide historical data required by the auditors. Number four, fulfill government regulations. And lastly, to provide a means of preventing, detecting, and correcting errors. And now, let's proceed to independent verification. So there are two operational reports produced by FRS. But in previous chapters, we have portrayed that the general ledger function as an independent verification step within the accounting information system. The FRS produces two operational reports. Number one is the journal voucher listing, and the second one is general ledger change report. That provide proof of accuracy of this process. Number one, let's talk about the journal vouching listing. This provides relevant details about each journal voucher posted on the posted to the general ledger. And the second one, the general ledger voucher listing provides presents the effect of journal voucher posting to the general ledger accounts. So I will show you in figure 8-12 and 8-13. So if you have your PDF with you, you can see how the journal voucher listing is used and how the general ledger change report is used. So just take a minute to scan it because it is in our PDF. Okay, now let's proceed to internal control implications of XBRL. Although the potential benefits of XBRL and associated web technologies has been extensively researched, less attention has been given to the potential controls implication of using XBRL. There are three areas of specific concerns which we are going to discuss here. Number one, we have the taxonomy creation, the taxonomy mapping error, and validation of instance documentation. Let's chop it out. Let's start with taxonomy creation. Taxonomy may be generated incorrectly, which result in an incorrect mapping between data and taxonomy elements that could result in material misrepresentation of financial data. Controls must be designed and put in place to ensure the correct generation of XBRL taxonomies. That is different from taxonomy mapping error, which this process of mapping the internal database accounts to the taxonomy tags needs to be controlled. Correctly generated XBRL tags may be incorrectly assigned to internal database accounts, resulting in material or or it has something to do with the financial data. It is the effects that it brings is material. And lastly, we have validation of instance documents. As noted, once the mapping is complete and tags have been stored in the internal database, XBRL instance documents, or let's say reports, can be generated. Independent verification procedures need to be established to validate the instance documents to ensure that the appropriate taxonomy and the tags have been applied before the posting to a web server. And now, let's proceed to the management reporting system. Management reporting system is often called discretionary reporting because it is not mandated. It means it is a choice if you are going to do this. This is one could take issue with the term discretionary, however, and argue that the Effective Management Reporting System, or MRS, is mandated by SOX legislation, which requires that all public companies monitor and report on the effectiveness of internal control over financial reporting. Indeed, management reporting has long been recognized as a critical As I was saying, it is indeed management reporting has long been recognized as a critical element of an organization's internal control structure. An MRS that directs management's attention to problems on a timely basis promotes effective and efficient management and thus supports the organization's business objective. Now let's proceed to the factors that influence MRS. So it is the management principles, management function, level, and decision type, types of management reports, responsibility accounting, and behavioral consideration. We'll be going to talk about it one by one. Let's start with management principles. Management principles provide insight into management information needs. The principles that most directly influence the MRS are formalization of task, responsibility, and authority, the span of control, or like how far and how huge the control is, and the management by exception. We also have the formalization of task. The formalization of task principle suggests that the management should structure the firm around the tasks it performs rather than around individuals with unique skills. Under this principle, it says that organizational areas are subdivided into tasks that represent full-time job position. Each position must have clearly defined limits of responsibilities. And the purpose of formalization of tasks is to avoid an organizational structure in which the organization's performance, stability, and continued existence depend on specific individuals, or like the boss, the leader. The organizational chart in figure 8-14 will show you some typical job positions in a manufacturing firm. Okay. let's proceed to the responsibility and the authority. The principle of responsibility refers to an individual's obligation to achieve desired results. Responsibility is closely related to the principle of authority, so they have like similarity. If a manager delegates responsibility to a subordinate, he or she must also grant the subordinate the authority to make decisions within the limits of the responsibility. In a business organization's lens, managers delegate responsibility and authority downward through the organizational hierarchy from superior to the subordinates. And for the implication for the MRS, this principle of responsibility and authority define the vertical reporting channel of the firm through which information flows. The manager's location and the reporting channel influences the scope and the detail of the information reported. In here, managers at higher levels usually require more summarized information. Managers at lower levels receive information that is more detailed. In designing a report structure, the analyst must consider the manager's position in the reporting channel. So let's now proceed to the span of control. A manager's span of control refers to the number of subordinates directly under his or her own control. The size of the span has an impact on the organization's physical structure. A firm with a narrow span control has fewer subordinates, so there are lesser subordinates reporting directly to the managers. These firms tend to have tall, narrow structures with several layers of management. On the other hand, firms with broad spans of control tend to have wide structure with fewer levels of management. So the figure 8-15 in our PDF will show that to you. Organizational behavior research suggests that wider spans of control are preferable because they allow more employee autonomy in decision making. So there are a lot of brains working, there are a lot of suggestions. This may translate into better employee morale and increased motivation. It is an important consideration in setting that span of control is the nature of the task. The more routine and structured the task, the more subordinates one manager can control. However, therefore, routine tasks tend to be associated with a broad span of control. Less structured or highly technical tasks often require a good deal of management participation on task-related problems. This close interaction reduces the manager's span of control. And the implementation for the MRS is that managers with narrow span of control are closely involved to the details of the operation and with a specific decision. On the other hand, broad spans of control remove managers from these details. These managers delegate more of their decision-making authority to their subordinates, so they are coordination or they are willing to hear the sentiments and suggestions of the subordinates. The different management approaches require different information also. Managers with narrow span of control require detailed reports, and the managers with broad control responsibility operate most effectively with summarized information. And now let's proceed to the management by exception. This principle of management by exception suggests that managers should limit their attention to the potential problems areas rather than being involved with every activity or decision. So this principle says to focus on the existing and future problems instead of looking around into a bigger image of the problem. Managers thus maintain control without being overwhelmed by the details. For the implication for the MRS, managers need information that identifies operation or resources at risk of going out of control. Reports should support management by exception by focusing on changes in key factors that are symptomatic of potential problems. Unnecessary details may draw attention away from important facts should be excluded from the reports. goals. So if you're having a broad perspective about things, you tend to forget the other details that are needed. Like for example, an inventory exception report may be used to identify items of inventory that turn over more slowly or grow out of stock more frequently than normal. Management attention should be focused on these exceptions. The majority of inventory items that fluctuate with normal levels should not be included in the report. And we are getting farther. And that's it. Thank you for listening.
So let us proceed to the management function, level, and decision type. The management function of planning and control have a profound effect on the MRS or management reporting system. The planning function is concerned with making decisions about the future activities of the organization. So planning can either be long-range or short-range. For long-range planning, it usually encompasses a period of between 1 and 5 years, but it varies among industries. So it involves a variety of tasks, including setting the goals and objectives of the firm, planning the growth and optimum size of the firm, and deciding on the degree of diversification among the firm's product. Short-term range planning usually involves the implementation of specific loans that are needed to achieve the objectives of the long-range plan. So we also have here control function, and this ensures that the activities of the firm conform to the plan. This entails evaluating the operational process for individual against a predetermined standard and when necessary, taking corrective action. So we have here 4 categories of planning and control decisions. We have strategic planning, tactical planning, managerial control, and operational control. So for strategic planning, this is usually implemented by the top level managers, and these are the board of directors, president, vice president, CEOs, and many more. So in short, these are implemented by the big bosses. For tactical planning and managerial control, these are implemented by the middle management. So this middle management are usually the general managers, branch managers, department managers, and etc. So for operational control, these are implemented or controlled by the operations management as well. So we have here examples of a strategic planning decision. This is usually, or it is to set goals and objectives of the firm, to determine the scope of business activities such as the desired market share, markets the firm wishes to enter or abandon, the addition of new product lines, and the termination of old ones, and merger and acquisition decisions. It also includes determining or modifying the organization structure and setting the management's philosophy. Also, we have the characteristics of a strategic planning. So, strategic planning decisions usually have long-term time frames. They require highly summarized information. They tend to be non-recurring. So, it means they are not repeatedly done. Strategic decisions are usually a one-time event. These are also associated with a high degree of uncertainty. They are broad in scope and have a profound impact on the firm. And strategic decisions usually require external as well as internal sources of information. So for second category of planning and control decision, we have tactical planning. And these are subordinate to strategic decisions and are made by middle management. These decisions are shorter term, more specific, recurring, have more certain outcomes, and have a lesser impact on the firm than strategic decisions. So, tactical decisions can be made from this. These are more on support system to effectively implement the strategic planning. So, for example, the top level management decided to increase the sales through increase increasing also the production units of the current period compared to the prior period. So in this case, 2021 and 2020. Let's say there should have an increase of 150,000 units. So this decision is an example of a strategic planning decision. So the tactical decision that we have from here is to set a monthly production report to accomplish the said strategic goal. So yun na nga, tactical decision is like a support system to the strategic planning decision. So management control decision involves motivating managers in all functional areas to use resources, including materials, personnel, and financial assets as productively as possible. The supervising manager compares the performance of his or her subordinate manager to pre-established standards. So if na-meet nung subordinate employee yung pre-established standard, that is the time where the employees or the subordinate will receive a reward, may it be through bonuses or other employee benefits offered by the company. Pero if the subordinate does not meet the standard, the manager or the supervising manager should make or take corrective actions. So by corrective action, pwedeng magbigay ng feedback ang manager to his subordinates about their performance on where a particular area they need improvement. So, ganun. Operational control decision ensures that the firm operates in accordance with pre-established criteria. So they are narrower and more focused than tactical decisions because they are concerned with the routine task of operation, and they are more structured than management control decision, more dependent on details than planning decision, and have a shorter time frame than tactical or strategic decisions. So operational control decisions are more on the operation or more focused on the operation process of the firm. So we have three standards or basic elements of operational control decision. We have the standards, performance evaluation, and corrective actions. So standards are pre-established levels of performance that managers believe are attainable, and these should apply to all aspects of operations such as sales volume, quality control over production, cost for inventory items, material usage in the production of product, and labor costs in the production. So once these standards are established, these will be used to measure or evaluate the business performance, which is in the second bullet, which is the performance evaluation. The decision maker compares the performance of the operation in question against the standard. The difference between the two is what we call variance. So when we say variance, for instance, that this is the difference between the expected price, which is also the standard price, to the actual price paid. So the difference between the two is what we call variance. So corrective action. After comparing the performance to the standard, the manager takes action to remedy any out of control condition. So corrective action is more like a remedy function. Next is problem structure and unstructured problem. Problem structure reflects how well the decision maker understands the problem, and it also has three elements. We have data, procedures, and objective. For unstructured problem, these are problems where any of the three characteristics, which is the data, procedures, objectives, are not known with certainty. So that's it for problem structure and unstructured problem. Let's proceed to the types of management report. So the term report tends to imply, So the term report tends to imply a written message presented on sheets of paper. It may be a paper document or digital image displayed on a computer terminal. It may also express information in verbal, numeric, or graphic form, or any combination of these. Next is we will know about the report objective, and we have two general reporting objectives here. We have to first is to reduce the level of uncertainty associated with a problem facing the decision maker. Second is to influence the decision maker's behavior in a positive way. We also have two broad class of management report, which is the program report and ad hoc report, which will be discussed in the previous slides. Next. So program report is the reports that provides information to solve problems that users have anticipated. So we have two subclasses of program reports. We have scheduled report and on-demand report. Scheduled reports produced according to an established time frame. It may be daily, weekly, monthly, or yearly. On-demand reports are triggered by events, not by the passage of time. So from the term itself, it is an on-demand report. We also have report tributes to be considered in order to have an effective management report. We have relevance, summarization, exception, orientation, accuracy, completeness, timeliness, and conciseness. So, a report that is relevant contains an information that support the manager's decision. So, irrelevance wastes resources and may even be dysfunctional by distracting a manager's attention from the information content of the report. Summarization: these are reports that should be summarized according to the level of the manager within the organizational hierarchy. Exception, orientation, are control reports should identify activities that are at risk of going out of control and should ignore activities that are under control. Accuracy: information in report must be free of material errors. Completeness: information must be as complete as possible. For timeliness, information can be no older than the period to which it pertains. And conciseness: reports should use coding schemes to represent complex data classification, and provide all the necessary calculation for the users. So these three report attributes are significant and useful in order to have an effective management report. Now let us proceed to the second class of management report, which is ad hoc reporting. In the dynamic business world, certain problem arises that require new information on short notice, which is, in this case, there is no enough time to produce the required information in that very short time. But currently, database technology provides direct inquiry and report generation capabilities. Managers with limited computer background can quickly produce ad hoc reports from a terminal or PC without the assistance of data processing professionals, and this is all due to ad hoc reporting. So increasing computer power point of transaction, scanners, and continuous reductions in data storage costs have enabled organizations to accumulate massive quantities of raw data. So this data resource is now being tapped to support ad hoc reporting that needs to or through the concept of data mining. So what is data mining? This is the process of selecting, exploring, and modeling large amount of data to uncover relationship and global patterns that exist in large database but are hidden among the vast amount of facts. We also have two general approach to data mining. We have the verification and the discovery. So for verification, this model uses a drill down technique to either verify or reject a user's hypothesis. Second is discovery model, which uses data mining to discover previously unknown but important information that is hidden within the data. This model employs inductive learning to infer information from detailed data by searching for recurring patterns, trends, and generalizations rather. So next is data warehouse. A central feature of a successful data mining initiative is a data warehouse of archived operational data. So a data warehouse is a relational database management system that has been designed specifically to meet the needs of data mining. So this is a central location. So the warehouse is a central location that contains operational data about current events as well as events that have transpired over many years. So that's all. Let us proceed to the next reporter.
Good day, everyone. No? So the next topic that I'm going to explain is the starting with the responsibility accounting. So what is responsibility accounting? This concept implies that every economic event that affects the organization is the responsibility of and can be traced to an individual manager. The responsibility accounting system personalizes performance by saying to the manager, this is your original budget and this is how your performance for the period compares to your budget. And fundamental principle of this concept is that responsibility area managers are accountable only for items costs, revenues, revenues or income, and investment that they control. In other words, responsibility accounting is a system of management accounting under which management accountability is established according to the responsibility delegated or invested to the various levels of management, and a management information and reporting system instituted to give adequate feedback in terms of delegated responsibility. Also, responsibility accounting involves the internal accounting, budgeting for each responsibility center within a company. The objectives of the responsibility accounting is to assist in the planning and controls of responsibility centers. So, responsibility accounting has two phases. We have the top-down and then the bottom-up information. The first phase is creating a set of financial information goals or the budgets, pertaining to the manager's responsibility, and then reporting and measuring actual performance as to compare to these goals. So the first phase is intended to the top-down phase of the responsibility accounting. Why I say so, Pag pansinin natin yung illustration dito, the 8-18 rather, yung upward and downward flow of information, Kung mapapansin natin, from the let's see, what's that? But I think from the precedent, or the production, the higher level of management rather, yun lang sabihin natin dito. The higher level of management, that's where the budget, allocated budget came from. So sila yung nag-decide kung kung gaano kalaki yung budget ni allocate nila sa pag-produce ng products sa different managers, So halimbawa as to the producing the products, the management has three managers, and yung tatlong managers na yun, meron ding tigtatatlong production units. So halimbawa nito, so yung mamaya mas may elaborate pa natin dito yung information, no, illustration as to how, no, yung flow ng information, no. So the second phase naman to responsibility accounting is intended sa result na ngayon, no. Ikukuha na natin ngayon, i-compare na natin ngayon yung result nung ginawa ng mga nung lower management sa allocated budget ng higher management, no? Kung mapapansin natin dito, yung arrow, this is the bottom up. Sa baba, papunta sa taas. So, mag-decide ngayon, no? Makikita natin ngayon, no? Kung may changes ba, profit ba, or loss yung nakuha natin as of producing the product. Setting financial goals. So, the budget process. The budget process helps management achieve its financial objectives by establishing measurable goals for each organizational segment. So, this mechanism conveys to the segment managers the standards that senior managers will use for measuring their performance. No? Budget performance flows downward and becomes increasingly detailed as it moves to lower levels of management. So, ngayon, no, kung previously, I stated na yung setting financial goals, ang nagsiset nito is yung higher level of managers, no? Papunta kay managers ng production unit 1. Halimbawa, si production unit 1 naman, i-allocate niya naman kung magkano yung possible na pwedeng ibigay niya kay managers production unit. So, halimbawa, unit 1, no? Yung managers yung manager plant 1, rather yung kanina. 2, manager production unit 1. Halimbawa, ganon. So, sila yung allocate. So, galing sa pinakataas yung budget, i-allocate niya kung magkano yung bibigay kay manager 1, manager plant 2, or manager plant 3, and then si manager plant 1, plant 2, and plant 3 naman, i-allocate naman nila kung magkano yung ibigay nila kay manager production unit 1, production unit 2, and production unit 3, as well as ganun din yung gagawin ni production unit, production manager plant 1 to 3. So, ganun yung gagawin nila. So, measuring and reporting performance naman, no? Performance, measurement, and reporting takes place at each operational segment in the firm. This information flows upward as responsibility reports to senior levels of management. So, ngayon naman, ay itong measuring and reporting naman, dito na natin i-test, no? Titingnan ngayon ni ni higher management, no? Kung yung set ba nila na goal, no, is not achieved. Kasi this information came from the lower level of management pataas kay higher management. Kasi si higher management, titingnan niya ngayon kung yung allocated ba nila na goal, no? Yung budget na allocated ba nila is tumaas ba, same lang ba, or nagkaroon ng loss. So, ganun yun siya. Responsibility centers, no? Yun nga, matatanda natin kanina, itong responsibility centers, no, is meron tatlo lang to siya. The cost centers, the profit, revenue, or income centers, and then the investment centers, no? Responsibility centers, to achieve accountability, business entities frequently organize their operation into units called responsibility centers. The most common forms of responsibility centers are cost centers, profit centers, and investment centers. So what is cost centers? Cost centers is an organizational unit, no, with responsibility for cost management within budgetary limits. For example, a production department may be responsible for meeting its production obligation while keeping production costs, labor, material, and overhead within the budgeted amount. The performance report for the cost center's manager reflects its controllable cost behavior by focusing on budgeted costs, actual costs, and variance from budget. So, the next center is the profit centers. A manager has responsibility for both cost control and revenue generation. For example, the local of national department store chain may be responsible for decision making about which is items of merchandise to stock in the store, what prices charged, the kind of promotional activities per products, no? The level of advertising, the size of staff, and the hiring of employees, building maintenance na limited capital investment. So, profit centers naman ito, sila yung mag-allocate, no? They are responsible in allocating kung paano pataasin yung profit ng production. Hindi tayo, remember that the why people are trying to make business because of the profit. Hindi tayo gumagawa ng business para magkaroon ng loss, para malugi tayo. Instead, we are engaging ourselves, no? The business owners or the persons, no? Or people engaging themselves into businesses, no? Business industry because they wanted to incur a profit, not loss. So, ganun yun siya. So, yung decision making natin dito, no? Importante kasi nga, ito yung signify, no? It could lead to a profit or loss sa management. Investment centers. Investment centers, the manager of investment center has a general authority to make decisions that profoundly affect the organization. Assumes, no, that the division of corporation is an investment center with objectives of maximizing the return on its investment assets. The division manager's range of responsibility includes cost management, product development, marketing, distribution, and capital disposition through investment of funds in products and ventures that earn a desired rate of return. So, next, meron tayong mga kwan dito. So, this illustration, the 8-9 illustration, the top-down flow of budget information, no? Kung papansin natin kanina, this is the setting financial goals or the budget process, no? So, kanina naka-state, no, that we have the 3 level of management, no, para i-consider dito. So, example dito na the vice president production, the manager's plant 1 or plant 2 rather, and then the manager production unit 2. So, kung papansin natin, no, the budgeted, no, allocated is coming from the higher level of management, which is the VP production. So, inallocate na dito, no, kung magkano yung pwedeng ibigay niya kay plan 2, which is the manager plan 2. So, kung papansin natin dito, no, it is allocated and stated here the 3,600,000. Yung 3,600,000 rather, no, yun yung maibibigay ngayon kay manager plan 2, which is the manager plan 2. Ito yung i-allocate naman, no, i-distribute na naman kay manager production unit 2. So, si manager production unit 2 naman yung mag-allocate, no, as to how much the materials, the labor, and overhead amount para makaproduce ng desired products ng higher level of management. So, the next illustration naman is the measuring and reporting performance, no, 8-20. The bottom-up flow of performance information. So, kung papansin natin, no, yung arrow papunta sa taas. Dito sa ito sa 8-19, no, simula sa taas, yung arrow papunta sa baba. Whereas itong 18-20, pababa hanggang papunta sa taas. Kasi nga, ito na, pagkatapos ngayon, no, i-budget ni manager production unit 2, no, yung materials, yung labor, and then yung overhead, no, as to the producing the products ngayon, si manager, pagkatapos na i-produce yun, i-allocate nila ngayon kung yung desire, yung objectives ba ni managers, no, the higher level of manager is not achieved, no, na-attain ni lower level of management. So, ngayon, titingnan na ngayon kung magkano yung labor, yung materials, yung labor, yung overhead, then yung production, and then ipupunta na ngayon yung kay production manager plan 2. And this manager plan 2 naman ngayon mag-ayos, no, mag-allocate ng mga amount. And then pagkatapos na, no, malinis na siya, no, ipupunta na ngayon kay VP production. Kasi nga si VP production siya na yung magsasabi nun na, okay, na-achieve natin yung goals natin. Okay, nagkaroon tayo ng loss. Or okay, same lang din yung amount. So, ganun yun. The next illustration, no, is the cost center performance profit. So, ito na yun siya, yung cost performance, i-allocate natin dito yung budget, yung actual, and then yung variance cost. Next one is the profit center performance report. So, profit center, no, i-allocate natin yung profit. So, sales, cost of goods sold, no, sale less cost of goods sold, gross profit, no, i-add natin less yung mga operating expenses natin. The investment center naman, no, before taxes, which is yung net income natin, kukunin na natin doon yung investment center natin. Bago tayo magdideduct, no? Dideduct natin yung taxes, no? Yung EBIT natin, income, the income, no? The net income before the taxes. Ganun yun siya. So what is behavioral consideration? Behavioral consideration is divided, no? Meron dito, goal congruence. So, a carefully structured MRI plays an important role in promoting and preserving goal congruence. On the other hand, a badly designed MRS can cause dysfunctional actions that are opposition to the organizational objective. So, paano kung nagkaroon ng dysfunctional, no? So, meron ditong dalawa. Two pitfalls that cause managers to act dysfunctional. We have the information overload, no? Or inappropriate performance measure. So, information overload occurs when managers, receives more information than he or she can assimilate. This happens when designers of the reporting system do not properly consider the manager's organizational level and span of control. So, nagkaroon, syempre, kung sobrang dami na ng information kahit hindi naman related, no, sa pag-evaluate, no, nung accounting responsibility, syempre, no, magkakaroon ngayon ng information overload, which could lead, no, to dysfunctional. No, yung manager act to dysfunctional kasi nga sobra na. Imbis na, di ba, yung information na kailangan natin, lahat tinambak na, lahat ginawa na, kahit hindi naman kailangan, no, binigay information na yun. So, it will possibly lead, no, to the dysfunctional manager's act, no. Next one is inappropriate performance measure. When inappropriate performance measure are used, however, the report can have the opposite effect using common preference measure or return on investment ROE. Assumes, no, that the corporate management of an organization evaluate division management performance solely on the basis of return on investment or the ROI. Each manager's objective is to maximize ROI. Naturally, the organization wants this to happen through prudent cost management and increased profit margins. However, when ROE is used as a single criterion for measuring performance, the criterion itself becomes the focus of attention and object of manipulation. So, yun yung sinasabi natin na inappropriate performance measure. So, that's all the accounting responsibility. Thank you so much and good day everyone.